Hello everybody, welcome to the first live stream of 2019 for Finance Agents. This is episode number 73, and today we're going to give you the state of lending in 2019 for finance agents and funding brokers. If you're out there selling money like we are, then you know that you're only as good as the products you're offering. So what do you have to sell? If you're selling the wrong thing, nobody wants it, or you can't sell it, or it's not funding, you got to constantly learn and adapt, and this is one of the things we spend a lot of time with our agents and offices doing. So today I'm going to quickly run through the 9 different types of financing or financial related services that we offer on a regular basis. I'm going to go through those, tell you what you're looking at in 2019 is good. Is it growing? Are rates going up? Rates going down? Whatever. Then at the end, I'm going to finish it up with our 3 big predictions for 2019 that watch and see. Note right now, January 9th, I said it. Let's see what happens. So running into it, first of all, let's start with commercial real estate. As you know, in 2018, we saw a lot of growth in our commercial real estate product. These are privately funded real estate loans for non-owner occupied properties. And this is what we are predicting going into 2019. First of all, the big lenders, we've had a lot of growth over the last, 4, 5, 6, 7 years. It's been growing constantly. While not a ton each year, it's been growing considerably. We predict that the private lenders who have been funding like crazy, I went and met with some people that are launching mortgage funds like what we have, and they said there were 2 or 3 launching every single week. What you are going to see is those lenders are starting to pull back. Defaults are starting to increase a little bit. We saw it bad in December last year. All of a sudden, like half the loans didn't pay at one time. So lenders are going to start pulling back, and rates will increase. Now, if you already think the rates are high, they're going to get higher, and this is a national trend you're going to see on a lot of different stuff. So expect it to be a little bit more difficult to get your deals funded. If you're going with traditional lenders, you're going to need the private lenders more because they're going to have a better risk appetite, but you're also going to see them change their mind more quickly. So rates go up and some pullback. Not major, but some. All right, the next one is 401k rollovers. If you have money in a 401k, you've been loving the markets for the last 8 years. But what we're seeing, we saw it a lot in the end of 2018, and we predict this is going to continue to happen. The market is getting a lot more volatile. People are getting nervous about their success of their returns in the market. People are starting to pull money out of the market and invest it into businesses when before they wanted to keep it there. So if you see people getting a 17, 18% return in their 401k, not likely to happen this year. It's a good time to pull your money out and invest in a business that will grow in a downturn. So we're seeing it already. We expect to see it more in 2019. Next product we are talking about is business credit cards. Now, business credit cards and personal term loans, those 2 products are very similar for us. So the information I'm going to tell you about one is going to be true for both of them. And this is the change that we're expecting. Over the past year, we've been telling people the ranges we've seen, anywhere from the cheapest we've seen is 6.9% rate up to 29.9%. That's the range. And average clients have been getting from 13 to 18%. Those are the interest rates. We expect the amount of funding to stay the same. If you qualify for $50,000 last year, you're probably going to qualify for $50,000 this year. We don't see that changing, but the rates are going to go up probably about 2 points. So when before it was 6.9 to 29.9, I'm imagining 7.9 up to even 34.9. We're seeing the rates go up that high, and averages are expected. We expect them to go from 15 to 20%. So expect amounts to stay the same, rates to increase. All right, next product we're going to be talking about is business term loans. These are SBA loans, or this is big traditional financing, and banks have been loosening up some. Frankly, for the amount of recovery we have over the last 5 years, I have not seen the banks loosen up as much as we expected, and I don't expect that to change. I don't see a retraction coming, but I sure don't see them expanding in 2019. One thing you know you're going to see is prime is prime's already gone up, and these are variable rate loans. They vary with prime. So as prime continues to go up, we expect interest rates to go up as well. And interestingly, we were not expecting this, but last year, as prime increased, now if you got a loan that's prime plus 2 and prime goes up, the whole loan amount goes up, you wouldn't expect to see a big change from the bank, but that's not the case. what we have seen is that the banks are actually cutting commissions. While their interest rate goes up and down with prime, they are cutting commissions. Some banks, not all, but they're cutting commissions to the brokers. We saw it with some of our lenders. We pivoted to the ones that aren't cutting their rates, but you might see that trend continue going into 2019. All right, next, equipment finance. Equipment finance is an interesting industry because there's a lot of big banks that do it, and there's a lot of non-bank lenders that do that. What we predict is that the banks are not going to have a lot of change. I don't see a pullback. There might be some pullback on the bank lending. And if there is, then you're going to see that business go to the non-bank lenders, which is going to exacerbate the rates will increase trend, right? So you've got really rate-sensitive clients. They may not take the equipment financing that they previously wanted to do. So as a broker, you might see that decrease. But the non-bank lenders are still going to be there, but they're going to be even more expensive. If your client didn't like them before, they're really not going to like them now because the rates are going to continue to go up. I'm not expecting anything drastic, but 3-4% increase, maybe more, especially in a riskier industry that might be hit by some stagnation, then expect the rates to go up. Fix and flip is among the next product we're going to talk about. Among all the different products we offer, fix and flip is probably the most aggressive, right? We have a lot of lenders that have gone up to, that'll finance 90% of the purchase and 90% of the rehab costs. What we are seeing is the fix and flip lenders we work with, they're telling us behind the scenes that they're seeing defaults increase. In fact, we had one lender that said they didn't have a single default. Now they got a ton, right? And a lot of this happened in the last quarter of 2018. So two things are going to happen. Rates are going to increase. You're going to hear that one a lot today. Rates are going to increase, and you're going to see, I predict 2 or 3 major fix and flip lenders could just plain fail in 2019. That's my personal prediction. What you're going to also see is that they're not going to be going, a lender that was going to 90 to 90 will still say they're going to 90% of acquisition, 90% of purchase, but what they're really going to be doing is 80 and 80. So they're going to continue to advertise what they did in the past, but fewer and fewer people are going to do it. Somebody that was going to 80%, you're going to see them going to 75, it's to 70. And if you are offering these products, you know that this is going to make it harder to get a deal done because somebody's going to have less money in order to finance what used to be 10%, now they get up into 20% in order to get the deal funded. Next product we'll talk about, merchant cash advance, ACH, what we call revenue-based advances. This industry exploded for about a 5-year period, and then over the last 2 years has been consolidating or retracting depending on how you look at it. A lot of, probably 20% of the lenders, maybe 30% of the lenders are gone. And this is not necessarily a bad thing. What you see is the big guys are taking over. What that means for you as a funding broker is that you are going to make less and less each time you offer this. You're going to be competing with larger companies. There are fewer of these loans are being offered because more people have done them and they know what they are. So people will like them less. The rates can't really go up because they're so dang high already, but the commissions are going to decrease. If you want to continue to sell this product and make money on it, you got to sell it for less, or you're just going to get slaughtered by the big guys that come in and maybe routinely only put a couple points in the deals because they're doing 500 deals a month and you're trying to squeak out 3. It's going to make it harder to compete as a funding broker. I think that is the last, no, I think we have one more product that we're going to talk about, and that is debt settlement. If you're going to bring that up, put it on the screen. Debt settlement is not actually a funding product. It's sort of a conclusion to funding. We've had a lot of funding happen over the last 6 or 7 years. The economy's been growing, people have been excited, they've been starting businesses, and when that rising tide has been floating all boats, businesses have been doing well and people have been pulling out more lending. Now that at a minimum the market is sort of consolidated, you're going to have volatility, not necessarily a lot of growth. You're going to see more businesses failure. People that made a mistake in their judgment and pulling out loans are going to be looking for ways to get out of it. Right? And one good way to do that is debt settlement. Commercial debt settlement has had a big rise over the last couple of years. It really exploded last year, and I expect to see the trend continue. More and more providers are going to come into the place, into the market. So there's a couple interesting things that are going to happen. One, if you're offering debt settlement, more people are going to want it, so that's good. But there's going to be more people offering it, which means you're going to sign a client up. You might get a commission or two, and then you're going to lose that client who's sold by another debt settlement company. Kind of crazy. I see these clients go in, they sign up with one, then they hop to another, then they hop to another, then they get some more debt, then they go to another one, and while you think you got a client, you lost him to the next guy that sold him. So it's a weird thing to make money on. You should only really rely on those first 1 or 2 commissions. If you get more, be happy about it, because these clients are hopping all over the place. All right, so that's a run through on all the individual products, and from all that, I'm going to give you Tim MC's and Finance Agents 3 big predictions for 2019. You're going to be able to guess some of these because you've heard me say them a lot over the different products, but let's jump into it. Prediction number 1 for 2019, the banks are going to hold. They're not going to be doing a lot more lending. They might be doing a little bit less. I expect sort of a steady state for the bank lending. And what that's going to do is it's going to add to the trend that we've seen over the last 5 or 6 years, where alternative and non-bank lenders are going to continue to grow. I wouldn't say they grew a ton over the last year because the banks have been growing, but I think that's going to stop. This is a long-term trend we're seeing. So alternative and non-bank lenders are going to continue to grow. On a side, I think we're going to see more partnership between the alternative lenders and the bank lenders. And when a bank partners with an alt lender, they get a lot of tech. They can put a lot of money into a space really quickly. I think you'll see the partnership, but I don't actually see the banks doing that second part where they dump a lot of money in. As you know, if you've been in the market a long time, when a bank comes into a space that they're not previously in, they will obliterate non-bank lenders because they can do so much lower rates because their cost of capital is so much lower. I don't think that's going to happen. You're going to see the partnerships, but you're not going to see that explosion of money. All right, so that's prediction number 1. Prediction number 2, rates will increase. All right? The Fed is raising rates. Rates are going to go up. Right? For all these different reasons, the economy as a minimum going to stagnate. Inflation's going up. Rates are going to increase in 2019. I'll put my money on it. Watch. I mean, it's already happening. It's going to continue to happen. The only thing that's stopping rates from increasing are usury laws, and a lot of the non-bank and alternative lenders are finding ways to lend that completely bypass usury. So rates are going to go up in 2019. I feel the most confident about that prediction. The third one, which is sort of a mixed effect on you depending on where you are or where your clients are or where you're borrowing from, is that you're going to see more and more state regulations, all right? Don't expect federal regulations to happen right now. If you're a Trump supporter, he's definitely delivered on that campaign promise. He's been slashing regulations a lot, not as much in the lending side as people that are trying to get money out there would like, but it's definitely happened. You don't expect a lot of growth in the CFPB, the Consumer Financial Protection Board. If you're doing consumer financing, you probably love that. But with the Fed out of it, the states have been ratcheting up their regulations, and it takes a long time for it to happen, but they're coming. We're already seeing it happen in different states over the last couple of years. Expect to see that more. The more the federal government says they're not going to do anything and that they're going to repeal stuff, individual states are going to do their own regulations, which is going to have a real patchwork effect depending on where you are. If you're in California, maybe you don't want to sell California financing. Maybe you want to sell to states where they don't have the regulation. You could do that. And that's why I say the impact is going to be real scattered based on who you are and what you are offering. All right, so that is it. I do have one extra random prediction and another thing that I'm seeing, and that's finance everything everywhere, right? Instead of the way it's been with a lot of things where I'm going to go find this and then I got to figure out how to finance it, expect to see financing offered more and more at the point of sale. You may go into a store and want to buy something and say that's too much, and you don't know if you have your credit card with you. They may offer on-the-spot financing, be this on the consumer side. The business side is a little bit slower to adopt it, but I'm definitely seeing it. So those are my 3.5 big predictions. If you are seeing any trends, please go to the notes. I think Darren's about to talk, so maybe somebody's already said something already. I would love to hear your feedback on any of these predictions, any of the things that are happening with individual lenders. Put it in the comments or put it into the notes at the bottom. Tell me what you are seeing. If you see something different than what I was saying or disagree with me, I love that. I like hearing people disagree. What are you seeing? What kind of comments do you got coming in there, Darren?
So I was just going to make a note. So you were talking about like financing everything.
Uh-huh.
Best Buy has been doing this for a little bit.
Right.
Where they will they have a credit card, but they'll do like 12 months, 0 APR to get people to finance their products, like higher ticket items.
Mm-hmm.
So you're seeing it a lot.
You're seeing a lot. I think you're going to see interesting applications at the point of sale, where you're there at the box clicking buttons and it says, do you want to pay for this over 3 payments instead of just right away? And they can do an instant approval with a soft pull. I think you're going to see some real interesting stuff. You're already seeing it online at different websites. A lot of people are offering their own financing. By the way, we have a really good partner. If you are a business and you want to offer financing for your products, we can help you do that. We've been using it for the last year for the people that sign up for member offices, so it's something we can help you do. But not just us. I'm telling you, I'm seeing it everywhere. Unless the market really moves down, which I don't think is going to happen in 2019, you're going to just see financing everywhere. Everybody wants to get into finance. It's the fastest growing industry in our economy over the last 10 years. Maybe, I don't want to say the fastest, one of the fastest growing industries. As far as GDP and segments, financing has been growing at a point that it's alarming some economists. Whatever, that's what it is. It's a trend. I expect it to continue.
Yeah, well, and if you think about it, it might be, people are looking at their paychecks and they're coming out at certain frequency, and they'll take that as the amount of money they have. Instead of saving up for one big ticket item, they'll pay it over a certain amount of time that they know that they'll have that amount of money for.
Yeah, I mean, I think just about anybody would rather pay for on Tuesday for a hamburger today, to quote Popeye. So you're going to see it more and more. It's just convenient. It's going to be easier. We're not talking about where you go to buy some furniture and you have to do a 30-minute application and it takes 3 days to approve. I'm imagining more instant approvals, more payment plans, more types of financing everywhere on all sorts of stuff.
Yeah. All right, so we have a question from Lawrence West. Sorry.
All right, hello, Lawrence. What do we got?
So he wants to know if we're going to get back into credit repair.
If we are going to get back into credit repair, that is a great question, and I would love to give you a better answer. We've had a credit repair program going for the last year in sort of private alpha. It's still there. That's all I can say about that. Credit repair, as you know, is kind of a tricky product for a lot of reasons that I'm not going to get into right now, but there's always a place for it and there are always people that need it. So I can't answer that question because I don't want to give you the wrong answer. I would love to. Not sure I have the right service to roll out right now. And when I feel confident about that, I'll go. If you've been with us a long time, you'll know that a couple years ago we did a big launch, and then the person that was running that partnership had some major medical issues, took the entire thing offline, and really messed it up. And since then, we've been really focusing on CRE, the private real estate loans, because you just make so much more money getting a couple points on $1 million. You make 20 grand commission at one shot as opposed to a $20 commission on credit repair. It takes a lot of one to justify not focusing on the other. But with that said, where there's a need, we want to fill that need and we want to work with you. If you got a great solution that you've been working with for a long time, don't call me up and tell me some amazing story about somebody who removes bankruptcies in a day. I don't care about that. What I care about is a consistent provider who is able to help people sign up, communicate clearly, and have happy customers. I'm more concerned about good customer service and low complaints than whether or not they're a magician or they do things which often sound very illegal. Right? I don't want to offer something that sounds way too good to be true. Any other comments?
Yeah, well, Stan Howard wants to know about the cannabis industry.
Okay, great. All right, good question. Cannabis, that is so interesting. It's one of the single most interesting things in financing that I deal with. I feel like there should be lots of cannabis financing already, and there is and there isn't, right? There's a lot of people offering it, not necessarily as many people funding it. If you're in it, if you're in the industry, you're going to see a lot of people talking about it. There's a lot of really difficult problems. The money can't go across state lines. The money can't be in a bank. A lot of banks won't touch anything to do with cannabis because the banks deal with federal laws. And who knows what Trump or the Attorney General or anybody's going to do at any moment. They're fully within their right to prosecute anyone. So the most likely thing you're going to see in the near term is in-state investors financing in-state customers. And that is not something that's scalable or easy to roll out. So you're talking if you're a private investor in California and you want to finance somebody who's purchasing a building for cannabis in California, it's still a problem because your money is in a federally chartered bank, So I expect to see it growing just like the cannabis industry, which is growing like crazy. But growing on a scale where we could have some sort of a national product is impossible. It's going to be So if you're in there and you're focusing on it, you probably make a ton of money. Being a funding broker, being a finance agent, it's all about arbitrage. It's all about having something that other people don't have. The problem is those things are changing. The smaller the investor, the smaller the product, the more likely it is to be here today, gone tomorrow. That makes it tough to have a consistent cash flow or business out of it. You don't want to be making a ton of money now, have the business die, and you're done. You got to pay the bills, right?
All right, yeah, we do have a few more comments, questions.
Awesome.
So Gregory, I apologize if I mispronounced.
Just say Gregory. Let's go with Gregory.
What about Siri? Commercial and residential refis. According to him, I'm going to need a commercial refi on a package of rentals that he purchased, and wants to know more information about that.
Sure, great. Well, we'd love to talk to you about it. We don't do anything residential conforming, meaning owner-occupied. So as long as you're talking about investment properties, we'd be happy to look at it. As a recap, what I expect to see is that private lenders are going to have a minor pullback this year and that rates are going to continue to go up. But with that said, I don't expect a major retraction. And if the banks do pull back a little bit, it's just going to add to the private lenders. So I think it's a great space to be in. And if the economy does go down, the more the banks pull back, the better space you're in with private lenders, as long as the private lenders aren't losing their shirt and having big defaults. You got to be with the right kind of private lender that understands that a default isn't necessarily a problem. It's only a delay. You got to have a patient private lender, which we are and we have access to, so we would love to look at your deals. Again, if you're looking for cheap, though, that's not going to be us. If you want commercial, like I see a lot of guys want to buy hotels and they're looking for 4 or 5% interest. That's not us. We can't help you. Go somewhere else. But if you're with somebody who understands that we adjust based on risk, we would love to look at your deal.
Yeah, and Francine had a comment about the discussion about cannabis and cannabis industry.
Mm-hmm.
That she said that there's many non-QM lenders financing cannabis industries. So
right, and that's exactly what I said. I just see it being erratic and inconsistent and temporary, which great. If you want to focus on doing that, you could make a ton of money. But strangely, I'm seeing a lot of people advertise it. So what I really think is happening is you've got a few people that actually have the lending, and then a lot of people offering it, which means if you go offer it now, you're going to have a lot of competition. A lot of your competitors are going to be smoke and mirrors.
Yeah.
Sorry to bring in a smoke analogy with cannabis, but it's the reality. They're going to be offering something that's not really true, and then the borrowers are going to have a tough time figuring out if you know what you're talking about. And if you're new to the space, frankly, you don't know what you're talking about. So, you want to get in with a lender, see real track records. With anything, if you're getting into a new space and you're talking to a lender, please have them show you the last 10 things they actually funded. You need to offer what they're actually doing, not what they say they're doing. They're going to tell you, I lend up to this, lend up to this. Forget what they said. Look at what they actually did and lend on, and that's what you promote to people, and then you're not going to be the guy who's selling vaporware all over the place.
All right, so Jeff has an excellent question.
Awesome. What do you got for me, Jeff?
All right, so Jeff wants to know, how are you better than the competition?
How am I better than the competition? Well,
we have
finance
a YouTube
agents.
show right there. End of conversation. YouTube show done.
Yeah, YouTube show. It's all Darren. That's why we're better. Finance agents is different. When you ask me how am I better than the competitors, I could give you 20 different answers based on whatever products we offer. So it makes it a little bit complicated. So I'm going to say from the position of finance agents as an organization that has sales, funding brokerage offices underneath us, we're different than everybody else because there's really nobody else that does it. I know Lendio has a franchise, right? They have a franchise, but you're just selling the Lendio products. There's nothing bad about what they do, but it's very specific, and we got people that go and open a Lendio franchise and then contact us for other products. The other alternatives is you have training systems where you go learn how to do stuff, and then that's it. You pay $30,000, $40,000. They train you for a week, and you're on your own, and good luck, right? So if you're a member office with us, We train you and work together with you. It's a working relationship. In that sense, we're much cheaper to get into, and you get way more because it's a working relationship where we grow and succeed together. So that's how we're different than competitors. If you go into all the different funding products, there's too many answers because, frankly, we change products all the time based on what is good. So whoever is best, we will switch and work with them. And that's an advantage over working with one lender. If you're working with OnDeck for revenue-based advances or merchant cash advances, that's great as long as OnDeck is the right solution for your customer. If you need lots of solutions, come to us and we can help you with that. Or you try to do it on your own, but it's difficult doing everything by yourself. So working with us, you're working with a team versus trying to hold the fort by yourself. Anything else?
Looks like that's
We'll wrap it up
that's
with
it.
that after talking about how amazing we are. If you're new to the show, please subscribe, come back, and we'll probably talk about how amazing we are next week. Next week, we're going to be talking about our new real estate masterclass. We did a show about this back in October before it's live. It is now available. So we're going to talk about what is in there, what you get, and we're still adding more stuff onto it, the things we're going to be adding in the near future. Please come back next Wednesday and learn all about it. If you're not experienced in selling private real estate loans, you definitely want to get in on this because a $20,000 commission is way better than a $20 commission, and it's not actually that hard to do. We had one member office sign up, and they did 5 deals in 6 months and make $72,000 in commissions. You could do that too, and that's all from private real estate. So come back next week. As it is, thanks for coming on Show 73, and I'm out.